Well, welcome everyone. Today we have a very interesting webinar for you all. It's what's trending right now in commercial real estate. So Colton and I, we put our heads together and we said, what is going to be the trends and what's happening right now in the commercial real estate market that is interesting, is something that, the people that we deal with every day need to know. What are we seeing? What's happening? And what do we anticipate to happen this year? And so this is where we're at, and let's get it started. So
First thing you need to know is that those that know us already, there's a lot of you on the call that know us already. We're not hoorah guys, and we're not like, come make billions of dollars with us, those type of guys. So we want you to know for sure that we want to add value to you today. And we want to add value by giving you information. And that's what we're about to do here. If we could get the slideshow to start going. Why won't I go now? There we go. All right. Second thing, our goal always, everyone's goal, especially the bald guys, is we want to know how to make money this year. It's not an easy market, but there are many paths to making money, and that's what we want to show you today in kind of our presentation and what we're doing.
And then at the end of it, if you stay to the end, we have a bonus for you all. And so that's kind of our trick to keep you to the end. So stay tuned.
Intros first, though. Let's get started. With some intros for those of you that don't know us.
Yeah, so I'm Derek Torno. I'm the co-founder of Commercial Loan Training and also the managing partner of M5 Commercial Funding.
What does M5 do?
So we are a boutique brokerage. We've been around for over 10 years, and we do commercial loans.
And I'm Colton Smith, co-founder as well with Derek. We've known each other for a long time, for better or for worse. It's been good, believe me. I'm a senior director at Walker & Dunlop. For those of you that don't know, Walker & Dunlop is one of the largest commercial loan brokerages in the entire country. We do anywhere between $20 and $75 billion a year in transactions, depending on the market. And we are a direct Fannie, Freddie, and HUD lender for multifamily investment properties. Along with other things. Tonight, I get to teach the real estate finance class at the University of Utah, which I love to do as well to kind of give back to those youngins that still have hair. So that's short on us, and you could find out more about us on our website if you want, and we'll go from there. So let's get going.
Yeah.
All right. Let's give you a market update first. And for those of you that don't know how rates work in the commercial real estate environment, rates are tied mostly to the 10-year treasury bonds. If you want to know where commercial interest rates are, and where they're going, you follow the 10-year treasury bonds. The 10-year treasury bonds are influenced by every bit of economic data that comes out nationally and internationally, including the Fed funds rate. And so, as many of you know, Fed funds rate has been dropping. And that does not have a direct correlation to commercial interest rates, but it does have an indirect correlation to long-term interest rates, because anytime the Fed funds rate moves, it can affect the 10-year treasury, believe it or not, up or down, depending on why the Fed funds is dropping. And so, as we've noticed, the Fed funds rate has been dropping, and that has helped the 10-year treasury actually drop, but the 10-year treasury has recently increased about 70 basis points. We're now about kind of 4.75, 4.8%, whereas we were, in the low 4% range just a month or so ago. And the reason for that is the next bullet point here is partially the election. So this is not a political standpoint or view. The election, whether it was Democratic office or Republican office, whether it was bipartisan in the House and the Senate or a full sweep by one or the other, there will be economic impacts that are perceived to affect commercial interest rates or the 10-year treasury, in turn affecting commercial interest rates. So when Trump was nominated, the market perceived the Republican sweep as inflationary based on what Trump was stating his goals were with fighting immigration, with his inflation policy, with his business policies, so on and so forth, that was viewed as adding to the national deficit, which in turn puts upward pressure on the Treasury bonds. The other thing that affects the interest rates are, go to the next one, is inflation that we mentioned. Inflation, the good news is that, you know, we're finally at a place or a trend where we believe that we're in a good inflationary environment, that we are either, depending on who you talk to, either at or around or on the way down to the target inflation goal of the Feds. So that's not been the biggest influence as of late. The bigger influence is jobs data. So once the Feds felt like inflation was under control, they focused everything on jobs data. So that's unemployment rate, non-farm payroll, employment participation, all the reports surrounding employment. And that data has not cooperated as we have expected. So jobs are still strong. Unemployment is still, percentage is still fairly low. And so for that reason, mostly we're seeing the 10-year Treasury increase. The reason we believe the 10-year Treasury to normalize and or decrease to a more normalized lower 4% range is we believe that the jobs data in the coming 2, 3, 4 months will will be a little bit more negative. So there'll be higher unemployment, lower participation, so on and so forth, and that will push the 10-year Treasury back down and moderate it. But the truth is, in commercial real estate, we don't necessarily care as much where the interest rates are. We care about stability. So technically, if rates are 7, 8, 9, 10%, and we know they're going to be there for an extended period of time, we could deal with that. We hate it. There's a lot less transaction volume, but we at least know what we're in for, and we could calculate future returns and risk a lot easier. And so the market collectively believes that once Trump takes office and we get a better sense of what his actual actions will be and his ability to carry out whatever his plans are, will then be in a more stable environment, which does spur a lot of activity with commercial real estate.
And so next is the capital flow. So capital flow, of course, is the ability to get financing for our clients, those investors that are looking for the ability to capitalize their properties that they're trying to finance. So
what we're seeing is last year, when the world was a lot more volatile in the markets, capital sat on the sidelines. So we had a lot of money amongst commercial real estate lenders, banks, credit unions, debt funds, credit funds, agency, you name it, and they were more hesitant to lend money. On the flip side, same was true with ownership. Owners, sponsors had money to spend to purchase, acquire commercial property, but they were a little bit more hesitant to do so because of the volatility of the market. Because we see a light at the end of the tunnel, we are seeing activity volume increase significantly, upwards of tenfold in our personal pipelines. And that is because, again, we see a lot more of a stable environment within the next 12 months. And therefore, it's making it easier to transact. And there's a lot more pressure on owners and lenders to put money out to make returns on those investments instead of keeping that capital flow. So there's an estimated over $500 billion worth of dry powder in the commercial lending space that they are trying to get out the door this year in 2025. And that's great news for all of us on the call.
Yeah. So this is why we put together this quick webinar for you all, is because Colton and I, we both do a lot of business, and we are in the market. We're talking to lenders. We have a good amount of clients that we work with, and these are the loan programs and projects that our clients are working on, and that what lenders are willing to loan on, and what are the hottest commercial real estate types right now. And so starting that off is multifamily construction.
Let me just hold on. Let me cut in. Sorry, Derek.
Yeah.
I just got a quick message on Messenger to everyone. If you have questions during our presentation, you can throw the questions out on Messenger or on the message board, and we will try to get to them during the presentation if it's relevant. At the end, we'll have a Q&A that you could ask either questions verbally, or we'll cover the rest of the questions that we didn't cover on the message chat group. So just want to let you know, if you have questions, you can throw them on there, and we'll hold the rest to the end.
Yeah. And we're going to go through a list of different property types, and they're not in any particular order, but we are seeing that, multifamily construction is very hot right now. And the reason why is there's still a growing demand for housing. Most cities across the country are suffering from the lack of housing, specifically affordable housing. But we're seeing that, more and more young professionals are moving to downtown areas. They are renting instead of purchasing a home. Home ownership is still doing, I guess, all right. We're not necessarily in that where we don't do a lot of SFR properties, but we do mostly commercial, and that's what we're seeing. And so lack of housing. So we're housed just south of Salt Lake City, and Salt Lake, they have a deficit of over 30,000 housing units right now.
And that is a common trend amongst almost every major MSA in the United States, except for a few markets. Austin and Phoenix are a couple of them that are oversupplied at this moment, but those will get absorbed within the next 18 to 24 months. But that's your backyard. More than likely there's a major lack of supply. And so there's a huge demand. And the reason being is that construction costs and the interest rates for construction went up so much that it wasn't feasible. It didn't make sense for developers to start building. But now they're seeing the demand and the need for more supply, and they're getting out there and making things pencil. Costs have either normalized or lowered in most instances, 5 to 10%, and the cost of capital has decreased as well. And so that's getting people out. So that means there's a huge need in almost every market in the entire United States for multifamily construction.
Mm-hmm. Like I mentioned before, rising homeowner cost is taking those borrowers out of the market for purchasing a home and putting them into rental units, driving the demand. Multifamily housing is a stable investment. It's one of those core investments that you can have a single family home investor. He could have 15 properties all across the state, but more than likely it is an easier investment for them to just have their one investment, have 50, 100 unit apartment complex just in one city, and it's easier to manage. It's very stable. You can have a property management company on site when you have the larger multifamily projects. So.
And all of you know probably better than us that it's easier, or most people start in multifamily investment when they get into commercial from residential, because they understand residential, and if they understand that, they understand a 4-plex, 5-plex, and then it's much easier to grow from there. So you're going to see a lot more of this opportunity this year than you had in previous years, for sure.
Yeah. All right. Moving on. Multifamily acquisition. This is those investors that are looking to purchase apartment complexes. There again, it's a stable investment. It's something that they're familiar with. And the reason why it's a stable investment, if you had a warehouse complex with, let's say 5 units, and it's much easier to rent out, to stabilize a multifamily apartment complex than it is to jump into an industrial project where you're not necessarily familiar with, and it's easier to manage. You can have a property management company handle everything. So it's more of a passive income investment for a lot of our clients. So there again, low vacancy rates, high demand, low vacancy rates. rising homeowner ownership costs again, and then the demand for permanent financing. So those that are on the webinar that are not necessarily super familiar with commercial financing, one thing about commercial financing that is much different than the residential world is that typically a 5, 7, or 10-year term is what is traditional for commercial. A lot of them right now are borrowers are taking the 5-year approach just because they feel rates are high, that they're going to be coming down. They don't want to be stuck in a long-term loan. They want to be able to refinance, pull cash out. And so a lot of notes are coming due. And so they're looking for permanent financing, another 5 to 7-year note. And so
$1 trillion.
Yeah.
That is the estimated amount of maturities this year alone in commercial real estate. Do you see opportunity there? You better. $1 trillion of maturities this year in 2025. So you need to be out there on the streets looking for commercial deals.
Yeah. And then lastly, rates. Rates, they're kind of, going up a little bit right now. However, I think everybody's anticipation is that they're going to, come down a little bit. And so, you have a lot of people on the sidelines ready to, jump if rates, trickle down a little bit. So.
We're in, just so you know, multifamily perm rates. I mentioned Fannie and Freddie, they're the most aggressive right now, are somewhere in the high 5s to mid 6% range, depending on the profile of the deal. And so that's where kind of the best commercial rates are, give or take.
So industrial property, yeah.
Industrial is cool. Industrial has been probably in many lenders' eyes the better property amongst multifamily and industrial, and that includes construction and acquisition, so perm debt. And the reason being is basically the Amazon effect. The Amazon effect is still flowing through the market. That is the demand for the e-commerce sector, like the Amazon effect, and also ceiling heights. So most of the industrial buildings that were built, say 10 years ago and previously, have 28 to 30 foot ceiling heights. And now, because of the capability of stacking pallets much higher, and it's cheaper to go higher than it is wider, there's more demand for higher ceiling heights. So 33, 35, 38, 40 foot ceiling heights, so they could stack pallets much higher in a smaller footprint. And that means extra dollars for that tenant. And so that is still flowing through almost every market in the United States as well. High demand, very low vacancy. And so you'll be able to get premium financing for all industrial properties that kind of fit that profile. The other thing is rents are on the rise because of the demand. And so you could sign a 10-year lease and have escalations built into that lease that will make your investor, the owner, sponsor, be able to project more income and project it much easier. So overall, an IRR on industrial is more predictable, and it's potentially higher than all the others right now. Mentioned low vacancy already, so that's good. And it's a very stable investment if you're investing in, especially in core industrial areas that are close to rails, airports, or the sea, or are in sub markets that have a lot of industrial in them. They're very stable investment.
Great. All right, moving on. Okay, SBA financing. So this isn't necessarily a property type, but we have seen a huge uptick in SBA financing requests. And so, right now I feel like the business confidence is rising. A lot of our clients that are, looking to purchase their first office, warehouse, they feel that, business is going well enough for them. And in the whole market that they're seeing is that they're ready to make a move. And so another nice thing about SBA is that they can get in as low as 10%. And there's even some ways that they can go under 10%, but the standard is 10% down payment, and they can get in to their own property.
I'll give you a freebie. This is a good one. So note this one down. It's not even in our notes. You can get 100% SBA financing, 100% loan to purchase price for a business, a good business like a doctor or an attorney. Think high quality doctors, attorneys that have been in business for a while that are currently renting their building and want to buy a building. It's called rent replacement. So if they're renting a building and they're saying paying $20,000 a month to rent that building, and then they want to go buy either that building or a different building, and their mortgage payment will be less than $20,000 a month, SBA can do up to 100% of that purchase price.
Mhm.
Not many people know that. That is a massive, massive secret. You're welcome, Shelby. I see you writing that down.
Yeah.
Thank you.
Yeah. And another tip, I recently closed a SBA loan where a borrower, they used one of their investment properties. They had enough equity in that, and they crossed with that for their down payment.
Question on the chat asks is if there's any suggestions on finding those loans that are coming to maturity. Unfortunately, there is no public data that is very good at that, capturing that information. And the reason being is that there's no reporting requirements by any governing body over any of the commercial lenders to report that type of information. And the other reason is that state law in many states prohibits or allows for transactions to not be publicly published other than a deed of trust, but not loan terms. And so it is very difficult. There are some applications or programs that try to do that, but they are not very good at it, and they cost a lot of money. And so the best way to do that is just be in the market and know. Honestly, my database is the best source of information for maturing loans, because every time I talk to a client, whether or not I do a loan for them, I ask them about their property, when they got the loan, what term they have on the loan, so I can mark it in my notes and put a little calendar reminder a year before it comes due that, hey, this loan is coming due in 1 year based on my conversation with this client. So unfortunately, that's the best way to do it. And you'll see in the market that you might be able to get some of that information. And the only way to pull up some sort of data that could be incorrect, but at least they try, is go to a title company, and they might be able to pull up some of that information for you. That answer, Carrie, your question, hopefully?
All right. Okay, another reason why SBA financing, I feel like is ticked up is rates are now lower. And why are rates lower? They're lower because most SBA financing is tied to the prime rate. And so, the prime rate shot up into the 8s, and now it's coming down. And so the interest rates for SBA financing are now lower, and that's on the 7A program. The 504 program is much lower interest rates than the 7A, and so it's just a great time for business owners to make the jump to purchase. But another thing, if you have a borrower that has a 7A, you can help them refinance into the 504, which will significantly lower their monthly obligation payment. So. All right. All right. And then hospitality, hotels, motels, holiday inns. So here we go. Okay, so hospitality, they had a huge drop during COVID. And the reason why is because, business travel was pretty much dead. People were not traveling. Most businesses, they were, jumping on Zoom like we're doing now. However, business travel is back. Hospitality, there's people that are out there, traveling with their families, getting out there. And so, hospitality is up, occupancy is up. And also, if you've ever booked a hotel recently, the rates are up. And so it's kind of the good and bad. We do hotel deals all the time, and we pay for it when we go and stay at the Marriott. So, and the last thing with hospitality is that they are SBA eligible. So there again, borrowers can get into a hotel with very little down.
The other property types, just so you know, so generally the requirement for a property to qualify under SBA is that it has to be typically retail, industrial, or office buildings, and the owner has to occupy 51% or more of the square footage. However, there are two exceptions to that rule. Hospitality is one of them. You could get an SBA loan on hotels, and you could get an SBA loan on self-storage. And the benefit to SBA is that they can get up to, as Derek mentioned, 85, 90% loan to value, because you could do conventional financing on those as well, but it's the loan to value that matters right now for most of these owner operators.
All right. And then our last property type is retail.
Man, I'll tell you about retail. Retail was bad during COVID. Can we all agree? It was pretty bad during COVID. All those mom and pops went out of business in the neighborhood retail center. They made a comeback, and the commercial market was sleeping on retail for quite a while. And so what happened is that they re-leased all these retail centers, and they didn't really increase the rents from pre-COVID. If they did, it was nominal increase. As we have learned since then, is that there's always going to be a demand for in-store personal sticks and bricks retail. And so we've had a lot more increased demand for tenancy. So all these things are full. These retail centers are mostly full in most markets, and owners are increasing rents substantially. And the other good news is that cap rates are still high, meaning values relative to the other property types are still fairly low. And so owners could get a higher return for a pretty similar risk profile than industrial or multifamily. So if you're in a good retail, deal, you could get higher financing, higher loan to value, and your sponsor is going to get a higher loan to value and a better returns. As I mentioned, growing rents are huge. There's some markets where they've grown kind of 25 to 40% since COVID, which is crazy to think, but it's true. So don't sleep on retail. I would say big shopping malls, they're still struggling a little bit. So asset type within retail matters. I would say that the most favored amongst all lenders is a grocery anchored retail center. So you have a grocer, name one of the big ones, and then you have a line of tenants that are connected to that grocer. That is the most coveted and the easiest to finance. The second easiest, I would say, is a shadow anchor center. So those are the out parcels that have maybe 3, 4, 5 tenants that are in the parking lot, essentially, of the grocery center across the parking lot. Those oftentimes are owned separately, and those are easier to finance as well, because traffic is driven through the demand for the grocer. The grocers spend a lot of time on demographics and knowing where to be at the right spot, and other tenants like that. It's also important to know the tenant type. The hard ones to finance, deals to finance, are all if it's a retail strip center, and it has a dry cleaner and a smoke shop and a mom and pop restaurant, and all these things that just have one location. They're not national. Those are much harder to finance, and we learned why during COVID, because those will go out of business a lot quicker. And then just your neighborhood shopping strip centers. So you have, maybe 5 tenants along a busy road. There's no major tenant in there, but they're all good, solid tenants. Those are still very, very good. And then the last one is single tenant, triple net lease deals. So your QSRs, which is your quick serve restaurants, your Taco Bells and Burger Kings and Chipotle, yeah, all those are very easy to finance because they are credit tenants. So very strong tenants that we know can make the rent, and it's just one building. So O'Reilly's as well has a lot of single tenants. Walgreens, CVS, Starbucks, yeah, all those are easy. What you don't want to see is the broken down old retail center in the middle of a neighborhood with all those small mom and pop tenants, and maybe even like an Airbnb or something crazy weird in there. Yeah, don't those are hard to do. Don't touch those. Right. Okay.
All right, moving on. Okay, so we talked about the hottest, trendiest property types. Now we're jumping over to the hottest loan types.
So what are the loan types that we're going to use to finance these scenarios? The first one would be construction loans. So construction loans, they are what they sound like. You get a loan from a bank for the purpose to construct a building. We're talking more specifically about multifamily and industrial. Those are what we call typically floating rate loans. So the rates are a floating rate over the SOFR index. SOFR is a secured overnight funding rate. You could look it up. There's a 30-day average SOFR rate that you could Google and find out what it is today. And then they add a spread over that of usually somewhere between 300 and 700, depending on the deal. And I mean 300 basis points to 700 basis points, which means 3% to 7%. So SOFR right now has dropped concurrently with the Fed funds rate. That's the one index that drops concurrently, or one of the two. Prime is another one. And that is at call it 4.35% right now. And so you're somewhere between 7.35 and 11.35, which sounds high, but it's pretty much better than it was even 6 months ago. So construction, you'll find a lot of demand for that, and the lenders you will use for that typically are banks and credit unions. Banks and credit unions.
And then next is bridge financing. So bridge, it has a construction component to it, and so it's a property that's not necessarily ready for prime time. They're typically vacant, or they need to have the rehab dollars in order to stabilize the property. So it could be like, for example, we're doing quite a few multifamily properties that, they purchased them. They spent the time to release the tenants from their contracts, get them out, and then they're coming back around and rehabbing the inside, outside of the interior, exterior of the property, and then they're going to re-tenant it, by raising the rents and getting, a better NOI on the property. And so bridge is typically to purchase the property and then also include the rehab dollars. And so, and the typical lenders for that, they could be anywhere from hard money to specific bridge lenders. Rates typically are higher. However, they're short-term loans, 6, 12, 18-month loans, depending on the size of the project. So.
All right, don't take notes on this one. I know, Shelby, you're going to anyway, but don't take notes on this one. Equity. Just so you know, there's a lot of demand in the market for this. So a perfect example that we're seeing nearly every day is someone that got a construction loan, call it 12 to 36 months ago, and they're just finishing construction and leasing up the property. Any property type, doesn't matter. They got the loan at a 2% rate, or starting at a 2% rate, but it was floating. So their rate now is 8, 9, 10, whatever, much higher. And during construction, costs went up. And in some markets, rents went down. And so their economics don't work anymore. But what's happening is these construction lenders are saying, hey, we're sick of holding out. You need to pay us off. And so these people are going out to the market to refinance their construction loan, and they're underwater in equity. And so they may have a $10 million construction loan, but they would only qualify for an $8 million loan based on the metrics. And so what they do is there's a ton of debt funds right now that do equity. And that equity is they basically fund that gap between what they need and what they qualify for. So in this case, someone would come in and fund a $2 million. It's not a loan, it's equity. So it's a preferred equity position where they get a preferred return plus some sort of waterfall or promotes. So they get to share in the deal economics essentially. And so they look for a minimum return of, call it 15% or higher, and they might have what's called a current pay interest rate. So you are paying a preferred return of 6, 7, 8, 10% to the equity partner, and then you will share the rest of the profits once they sell or refinance the property at a profit above that. And so that is happening a lot, just so you know, it's out there, but there's no list of equity providers out there anywhere in the United States of America that you could just, call these people and say, hey, can you do this? They're not lenders. It's Uncle Bob. It's, Guido from New York that'll chop your legs out if you don't pay him back, that kind of stuff. And there's more institutional money for this as well. but it's out there. Just so you know that those people are out there. And if you have a scenario like that for a very good client, you could call Derek or myself, and we might help you with that request.
Yep. The next is SBA financing. So SBA, as you know, is Small Business Administration, and it is focused on owner-occupied property. So the business owner needs to occupy at least 51% of the property. And the benefit for the business owner is that the down payment requirement, like we mentioned before, is much, much less than if they were going to a traditional permanent financing, conventional commercial loan. And so the difference would be, SBA, the standard is typically 10%. Sometimes, like we mentioned before, it could be less. Sometimes it could be a little bit more, up to 15%. If they go outside of SBA and they just want to go and get a regular conventional loan, then rates or down payment requirements going to be anywhere from 25 to 35, even 40%, depending on the property type. And so SBA, there are some major advantages to SBA, and so don't sleep on it. It's a great property type, especially if you're working with business owners.
And by the way, speaking of trying to help you make money, you can make more money on SBA loans. You could, in some instances, you can make yield spread, which is not common in commercial, by the way. In fact, 99% of commercial lenders do not pay broker commissions or yield spread at all. It is all borrower paid. SBA is one of the exceptions to that rule in some instances. So you can make more money on SBA deals.
Mm-hmm. Yeah.
Rob those business owners live. No, I'm just kidding. You don't want to do that. But yeah, you can make more money.
Yeah. I wish we were a charity, and we just
no, we want to make money too.
So,
but we're nice. We're nice at it. Like we're like, hey, can you give me that $1 million commission, please?
Yeah.
That kind of thing.
So all right. So in summary, capital is available. If you're working with clients and they are looking for financing, reassure them that there is money out there for them. It's just they have to meet some guidelines for it, but it's available, and there's quite a bit of money sitting on the sidelines. So the 2024 tire kickers are now the 2025 ready to move.
Movers and shakers.
Yeah, let's make it happen.
It's not a joke. My pipeline has increased tenfold since just 3 months ago.
Yeah.
And it was big to begin with.
Multifamily, industrial properties, hospitality, SBA financing, retail, all these property types should be, on your hit list of what you want to go after.
Please, please, please do not go after any office buildings. They are still struggling big time from COVID. You'll even find some, they're like, oh man, this looks so good. This is amazing. No, most lenders will not touch it. And
there's no vacancy.
But there's no vacancy. Oh, well, still lenders are still bleeding from their losses from, office foreclosures over the last couple of years. And there's still not a clear path to office. There are some exceptions. I wouldn't worry about SBA financing for office, so an owner user office building, that'll be fine. And a medical office building, that'll usually be fairly very good. But anything else, it's a very, very, very long shot. So don't look into that. And there's all the others are decent. So the ones that we didn't mention, like self-storage, seniors housing, what else? Hangars even. I mean, there's mobile home parks. They're all very good financeable properties right now. Really the only one that is not is office, but we just mentioned the hot ones that everyone is after right now.
Yeah. And if you hear anything negative about commercial real estate in the media, it's typically based off of office and,
solely. Yep.
And lenders, I mean, they look at the market and, wherever you may be across the states, you may have a really hot, office market right now. However, they're looking at the whole market across the country, and they're seeing, San Francisco, that's hitting the media a lot, of lots of vacancies there. A lot of big companies are pulling back and moving from California to Texas, or from Texas to Florida, and so they're seeing that and leaving behind a lot of vacancies. And so,
all right, I hope you could tell by now that Derek has unlimited knowledge in this space, and both of us like teaching people, especially residential loan officers, because you guys are the ones that are in the trenches. You see these more often, and there's opportunity for you to grab income. I bet you dollars to donuts, every single one of you on this call has missed commercial commission opportunity, commercial deals, where people send you deals and you just don't know what to do with them. So you just pass on them, or you send them to someone else that gets them done and makes the commission for you. So nice of them. So because of that, we have created, and some of you on this call have come to that. That's why we know many of you, and we appreciate all of you. We've created a commercial loan mastery. The commercial loan mastery is a 2.5 day intensive training, heads down training, where we teach you everything A to Z on how to originate, underwrite, process, and close and market commercial loans. We go through deep dive on underwriting, how to come up with loan amounts. We go through a deep dive of which lenders are out there, who they are, how they underwrite. We go through all the loan types, all the product types. We give you a list of lenders. We give you a list of leads, and we help you close your first deal. The investment for this class is $5,000, which we know is steep, but this is why we do it. Number one, we want serious people. But number two, if you go to the next slide, it works. Yeah, that one takes a little bit. So the smallest deal that we've heard of closing from one of our students is a $750,000 SBA loan from Chris that came to one of our trainings. And it was an SBA deal that he got 2% on. So that more tripled his investment in the class. Then they get bigger from here. We are closing a multifamily $15 million deal with Keith, another former student. He's doing it through us, Walker & Dunlop, as a lender, and he's getting a 1% fee on that one, which is $150,000. And then this one, I don't know if we'll see a bigger one than this one from some of our students, $150 million. It's actually 163 million, but $150 million construction and equity capitalization, I would call it. So we did a construction loan plus equity, institutional equity, and Doug and Jerry collectively brought this from a connection that they have, and they are making $750,000 on this deal. And there's so many others that we could talk about, but we just wanted to highlight a few of those because we know it works. We love having them make money because it makes us feel good. And there's really nothing out there like it. So if you want to learn more, there's the website commercialloantraining.com/fast track. You could schedule a call directly with Derek and myself, and this is your bonus. We
45 minutes for you.
Yeah, okay. I guess I committed to for you, I guess. So yeah, 45 minutes, half an hour to 45 minutes specifically on your business and how to help you elevate your commercial side of your business based on where you are and what you're doing. And then we could give you more information on the mastery as well. So with that, and this is what our calendar system looks like. So you could schedule a call on that link, and it'll be Derek, myself, or Tyke, and we'll answer your questions and go through that personally. And questions.
Yeah.
So we can open it up, unmute yourself if you want to ask a question live, or if you're too scared, you can send it on chat and we'll answer a few questions and call it a day. Thanks for your shout out, Alan. Both Alan and Shelby on this call were the best of the best in our training classes, and it's great. So how do you get paid by the borrower on SBA deals? It's the same. That's what Alan asked. It's the same way you get paid by anyone on any deal.
Yeah.
Which is you put it on the settlement statement as your fee. It's usually a 1% origination fee. It is very common in the commercial world that the borrowers pay the fee. So you get your 1% origination fee to either your company or the company that you work for, and it goes through whatever splits you have in your company, or if it's you personally, you get it all. And then you can, depending on the deal, most 7A loans, there's an opportunity to make 1% on the back end, and that is through the lender. Next question is, do you need to be licensed? It depends on the state, Don. Good question. If you look at your map there, right to your left, Don,
To your left, Don.
Yeah, up to,
Yeah,
behind your head now. Yeah,
behind
no. There are, we believe, 44 states that do not require licensing to do commercial loans, believe it or not. You probably know which states if do require licensing if you're in that state, because they're after you all the time. But it's we believe it's California, Nevada, Idaho, the Dakotas, and I think I'm missing a couple, but most states do not require it. I would say most, I think all red states do not require it, and some of the blue states do, believe it or not. So that's what it is. And some states require different licensing too. Like I know California requires a DRE, a division of real estate. So your real estate broker's license and not an MLS license, which is strange to me, but that's what it is. And then, okay, next question.
Troy had a question about.
Are borrowers able to buy down rates on either commercial or SBA? So good question, Troy. There are two lenders that I'm aware of that allow you to buy down rates, only two, and that's Fannie Freddie. Well, I guess those are two separate lenders, but Fannie Mae, Freddie Mac on their agency financing, which is just stabilized apartments, and then CMBS, commercial mortgage-backed security lenders. They will allow you to buy down interest rate. SBA does not. Banks do not. Basically, most every other option does not. Alan mentioned New Jersey, Arizona, Nevada. No, I think all those states do require licensing. Alan, it's funny because there's a fuzzy guideline. You'll go on the website and on their division of real estate and their commerce website for all states, and some will say one thing but practice another. Yeah, Omar, I will say Nevada does require licensing. In fact, Nevada is one of the most strict, it is the most strict, I'd say, in the entire United States of America. They not only require licensing, but they require you to have a physical address for representation in that state. So if you are already licensed, Omar, as a mortgage broker, then you're licensed. It's not a separate license. Anyone that requires a license, more than likely, already has their mortgage license. It's one and the same typically, except for California, I believe. Rick Trepas, good to see you again. Is there any DSCR financing out there for higher density, like 12 plus units? So Rick, that is a loaded question. The answer is every single investment property financing out there for commercial real estate is technically DSCR financing, but it is not the same DSCR financing that you are aware of.
Exactly.
So they market. So there are specific lenders that do what's called DSCR financing geared towards SFR investment properties. And it's the same concept in commercial real estate, but it's much more difficult. The NOI that they underwrite to is a lot more difficult. There's a lot more line items, and it's a lot more of a science. But every commercial investment property has a net operating income, and every single lender that lends on commercial investment properties runs a DSCR test to determine the loan amount. So in a way, yes, Rick, but not the way your most residential loan officers believe.
Got it.
So Alan, you're saying California, New York, Idaho, North Dakota, South Dakota, New Jersey, Arizona, Nevada. I believe that's a list. I think New York is not on that list, but it might be. But I think that is correct, somewhere in that. You're in the right range. Oh, New York for sure. Okay. See, Alan knows more than us on something. We'll send you a gift card for that one, Alan. All right. Any more questions, or do we want to depart early?
We want to thank everyone for taking the time to join us. Hopefully you got some value out of this webinar. Go out there, focus on these property types and these loan programs, and there are a tremendous amount of deals out there for you. So put in the effort to go find them and make some money.
So a couple more questions, late questions came out. Troy, I don't quite understand your question. Is there one industry at the moment 2025 more vulnerable than others as far as timing? I don't know if I understand. I think all the ones that we mentioned are the ones that are, you know, have urgent timing for whatever reason. And so I don't know if that answers your question, but you could unmute and ask if you want.
Yeah, it does. I just didn't know, right now, a lot of knowledge I'm getting from anyone out there in California, Sacramento areas, there's a big push this year for traveling nurses and multifamily homes for elderly. So I've got investors coming to me that want to buy up a bunch of homes, 5, 6 bedroom homes or possibly multi-unit, as the industry is really changing to have more in-home care for elderly, but also post surgery. Here it is really hot in California. People that just want multifamily homes and go to a facility privately. Um,
Yeah,
so
almost
not
like
not
short-term skilled nursing style is what you're saying?
Yeah, just people that have met or have surgery, to their body, or they're just going to a post closing facility to basically hide out and heal. So that's pretty big what I'm hearing out here in Sacramento. That's not the vulnerability question. Just wondering if it's medical or retail, or if there's one. I know loans that are coming due soon are important. I just didn't know if there's one, if it's medical or retail or any of those that are really, those loans are coming due. But you said there's a 1 trillion amount coming due, so pretty much everyone's in that same boat.
Yeah, it's a smattering of property types amongst that $1 trillion that's coming due. I would say you would see more in the multifamily space just because there's more apartments out there than there are the other property types. But to your point on the, short-term care stuff, every market's going to be different. So, that's hot in your market, whereas it's not hot in Salt Lake City. And so it's really a matter of knowing your market and knowing how you could provide value in that market. So if that's something that you're seeing a lot of, then I would look at options to finance those properties to meet that demand. Because I think that's a great idea in general. I mean, that's in anyone's business. That's a smart idea. But there's no like one property type or one thing that we're seeing that's like, hey, this needs to be done. What we mentioned before is something that you probably won't be able to take care of based on your knowledge right now, is that equity need for deals coming out of construction or underwater. We're going to see a lot of those, and those are going to be urgent. We already have, and we will see more of them. But there's a lot of work that goes into kind of finding the right solutions there, and every solution is different for that one. So I would find the low-hanging fruit that is easier to do, yet has high demand.
Thank you.
Yeah, go ahead. Oh, sorry. So someone mentioned, so John Raleigh, I saw Essentials program and online course. If I do the online course, do I need the Essentials too? No, the Essentials is basically a teaser for the online course so that you pay a very little amount to understand what we teach, and we give you some value for that Essentials course. And so you can buy, we do have an online course, which is a recorded version of our entire loan mastery, but you don't get the bonuses with it. We don't give you all the leads. We don't give you, we give you some lenders, and we only give you a couple different tools that you could use. As Shelby and Alan could attest to, we give you a file full of more information than you can digest, but all the documentation that you would need throughout the entire loan process. That's what you get in the live, and you get our support in the live. So yeah, if online's best for you, that's out there, that's available, and you could do that, or the live. We prefer the live, not because it's more income, just because we get to answer your questions live, and we get to cater the class to you and what you're learning, because it's a lot of one-on-one and case study and work that way, and you don't get that attention in the live, but either one is fine. Our next training, Omar, if you go to commercialloanmastery.com, commercialloanmastery.com is February 28th through March 2nd in Orange County. And then we have one in March, the end of March, the 28th through the 30th in Orlando. Those are the two upcoming that we have scheduled as of right now. All right, I think that's it. I think we will end 3 minutes early unless there's one last question.
Oh,
Oh,
Carrie, do you have a question?
Yes, I do.
oh,
On the SBA 100% rent replacement takeout loan, can that be used on any loan in existence, or does it have to be an SBA loan that we're taking out?
Well, it doesn't have to be an SBA loan that you're taking out. It can be used on a purchase or refinance.
going into an SBA loan.
Going into an SBA loan.
Okay, but it doesn't matter what the financing is that they have going in.
Well, no, I mean, typically if they have some sort of financing going in, they have equity in the property. And so they would tap into that equity, on the refinance side. And that would be, because most SBA loans, they have to hit a 90% LTV. So.
Right. Right. Okay, that was it.
But it's really meant, Carrie, it's really meant for those that are currently renting and their rent payment is higher than what their mortgage payment would be.
Yeah.
That's typically what it's used for. They can have a current mortgage and it might work there, but it's more frequent that they're going from renting to owning.
Okay.
Yeah.
That makes it clear. Thank you.
Great.
Appreciate your time, guys.
Yeah, thank you. Thank you, everyone. And if you feel inclined and have additional questions, use that link, schedule a time with us, and we'll jump on the phone with you and answer all your questions you have. And so thanks a lot, everyone.
Thanks, everyone.
Just click anywhere on this video, you'll be taken to the next page where it's down for you. Still with me, this is big. Don't believe me, go see for yourself. Banks back offers 0% funding. It's actually everywhere on their websites. Even investigate